Suppose you own a small business and want to expand, but your ambition outstrips your financial capacity. How do you raise funds? Well, you basically have two choices. You could borrow the needed funds from willing lenders with a commitment or bonds to repay them with interest. This means that you issue your lenders debt or bonds. Or you could give up some ownership of the business to keen investors in exchange for the funds. This means that you issue your investors equity or stocks in the business. Let's explore that second option and peek into the world of the equity asset class. As the owner of that business, you would publicly list the business on a stock exchange like the New York Stock Exchange. That's done through an initial public offering or IPO, which lets you sell slices of ownership in the business to the public. Those ownership slices are called shares or equity, and the buyers become shareholders in your newly minted publicly traded company. So you get the funds you need, the shareholders get a stake in the company in exchange for investing in your vision, and the return on their investment is now linked to the profitability of the business. If a business earns a profit, it may pay out a portion of that to its shareholders as dividends. It could also reinvest the profits into growing more value, either in-house or by acquiring other businesses. Moreover, it could buy back some of its shares from the stock market, which reduces the supply of tradable shares and boosts the price of outstanding shares, making its shareholders' holdings more valuable. On the other hand, if a business makes a loss, it may cut dividend payments to its shareholders or stop them entirely. It could also be unable to improve or expand operations and acquire assets or other businesses, unless by dipping into its cash reserves or going into debt, which could spell more trouble ahead. The same goes for share buybacks. An unprofitable business could do it, but only by draining cash reserves or borrowing. In a nutshell, the more profitable a business becomes, the more valuable or in demand its shares get in the stock market, which raises its share price. The opposite is true for an increasingly unprofitable business. So, if a shareholder sells their shares in a consistently profitable business, they would likely do so at a price higher than they originally paid for them. In other words, they would gain on their capital or realize a capital gain. So dividends and capital gains are the two ways you can realize an economic benefit from equity assets. On the flip side, if a shareholder sells their shares in a consistently unprofitable business, they would likely do so at a price lower than they originally paid for them. In other words, they would lose on their capital or realize a capital loss. Moreover, unprofitable businesses eventually go bankrupt, which means total capital loss for shareholders. Clearly, equity assets are very risky as your principal is not guaranteed. In fact, when the company goes bankrupt, it liquidates its remaining assets by selling them off for cash, and it must settle its debts first before its shareholders get any leftovers. That brings us to different types of shares and the rights they give to shareholders. Broadly speaking, we have ordinary or common shares and preferred shares. Moreover, preferred shares can be of cumulative, convertible, redeemable, or retractable type. Ordinary or common shares grant shareholders voting rights on business decisions, but they come with variable rate unguaranteed dividends, as well as the lowest priority for both dividend payment and, in a bankruptcy, capital repayment. On the other hand, preferred shares do not grant shareholders voting rights on business decisions, but they grant them fixed-rate guaranteed dividends and the highest priority for both dividends and, in a bankruptcy, capital repayment. With cumulative preferred shares, if the business issued dividends but missed paying them in the past, all unpaid dividends accumulate and must be paid to shareholders in the future. Meanwhile, with common shares, missed or unpaid dividends are gone forever. Common shares usually have larger capital appreciation or share price growth than preferred shares. With preferred shares, the bulk of the returns are the guaranteed dividends. With convertible preferred shares, each share is eligible for conversion into a predefined number of common shares, either at any time the shareholder wants or after a restricted period. Meanwhile, common shares cannot be converted into preferred shares at any time. With redeemable or callable preferred shares, the business has the right to sell the shares back to the shareholder at a preset price after a preset date. Meanwhile, common shares belong to the shareholders forever until they decide to sell them. With retractable preferred shares, the shareholder has the right to sell the shares back to the company at a preset price after a preset date. But if they don't initiate a sale by that date, the business has the right to force them to do so in what's called a hard retraction. In some cases, the business will convert those preferred shares into common shares instead of paying cash to the shareholder in what's called a soft retraction. Meanwhile, all of this doesn't apply to common shares, which the shareholder owns forever until they decide to sell them. Now let's see the different ways the equity asset class is further diced and spliced. According to the Global Industry Classification Standard, or GICS, there are 11 equity sectors. They include communication services, consumer discretionary or consumer cyclical, consumer staples, also known as consumer defensive, energy, financials, healthcare, industrials, information technology, or technology for short, materials or basic materials, real estate, and utilities. Moreover, the US equity market is the big kahuna with roughly 60% of the global equity pie. These 11 equity sectors can be grouped into defensive, cyclical, and sensitive buckets based on how correlated their performance is with the overall economy. Equity sectors in the defensive bucket are consumer staples, healthcare, and utilities. Defensive stocks provide consistent dividends and stable earnings regardless of the state of the overall economy. That's because there's a constant demand for their products, so they tend to be more stable during different business cycles, which means they have low volatility or risk, resulting in smaller downside in economic bursts and smaller upside in economic booms. Equity sectors in the cyclical bucket are materials, consumer discretionary, financials, and real estate. Cyclical stocks provide fluctuating dividends and earnings that correlate with the overall state of the economy. That's because there's a cyclical demand for their products, with higher demand in economic booms and lower demand in economic burst phases, which means they are more volatile than defensive stocks, with larger downside in bear markets and larger upside in bull markets. Equity sectors in the sensitive bucket are communication services, energy, industrials, and technology. They are more affected by the ebb and flow of the economy than defensive stocks, but not as much as cyclical stocks. It's interesting to note the similarity in the US and global capital allocations to each sector, but there is divergence when it comes to materials and industrials, where the rest of the world allocates more capital than the US, and technology and healthcare, where the US allocates more capital than the rest of the world. So what defines businesses in each equity sector? Also, what are the largest companies in each sector? Let's find out. Consumer staples sector includes businesses meeting consumer needs whose revenue is not tied to the consumer's disposable income. The sector covers industries like food, beverage, tobacco and cigarette, household and personal care products, and supermarket chains. Looking into these industries globally, we see that the largest food companies are Nestle, McDonald's, and Unilever. In the beverage industry, Kwechao Moutai, Coca-Cola, and PepsiCo are the biggest businesses. Philip Morris International, Altria Group, and British American Tobacco are the leading tobacco and cigarette firms. In the household and personal care products industry, Procter & Gamble, Colgate-Palmolive, and Reckitt Benckiser are the largest companies. Lastly, Walmart, Costco, and Target run the biggest supermarket chains in the world. The healthcare sector covers companies that develop drugs and treatments or provide healthcare equipment and services. The sector includes industries like pharmaceuticals and treatments development, medical devices manufacture, testing and diagnostics, health insurance, medical care facilities, and telehealth services. Looking into these industries globally, we see that the largest pharmaceuticals and treatments development firms are Eli Lilly, Novo Nordisk, and Johnson & Johnson. Among medical devices manufacturers, Abbott Laboratories, Stryker Corporation, and Intuitive Surgical are the biggest businesses. The leading testing and diagnostic companies are Thermo Fisher Scientific, IDEXX Laboratories, and Quest Diagnostics. The largest health insurers are United Health Group, Elevance Health, and CVS Health. AIER Eye Hospital Group, Bangkok Dusit Medical Services, and Herdo Sao Luis run the biggest medical care facilities in the world. Lastly, Doximity, Teladoc Health, and Lifestance Health are the leading telehealth companies. The utilities sector includes companies that provide services in the electric, water, gas, and renewable energy fields. The sector covers industries like electrical power generation, transmission or distribution, natural gas transmission and distribution, water supply, renewable power production, and diversified utility. Looking into these industries globally, we see that the largest electrical power generators, transmitters, or distributors are NextEra Energy, China Yangtze Power, and the Southern Company. Among natural gas transmitters and distributors, Naturgy Energy Group, the Hong Kong and China Gas Company, and Atmos Energy Corporation are the biggest firms. American Water Works Company, Severn Trent, and Essential Utilities Inc. are the largest water suppliers. The leading renewable power producers are Constellation Energy Corporation, Verbund AG, and CEZ AS. Lastly, Iberdrola, Enel, and ACWA Power Company are the largest diversified utility companies in the world. The materials sector covers companies that provide various goods for use in manufacturing and other applications. The sector includes industries like chemicals, construction materials, packaging and containers, metals and mining, and paper and forest products. Looking at these industries globally, we see that the largest chemical companies are Linde plc, Air Liquide, and Merck. Cement Roadstone Holding, Holcim SA, and Ultratech Cement are the biggest construction materials businesses. The leading packaging and containers firms are Avery Dennison Corporation, Ball Corporation, and Packaging Corporation of America. BHP Group, Rio Tinto, and Glencore are the largest metals and mining companies. Lastly, the biggest paper and forest products firms are Klabin, UPM, and Suzano. The consumer discretionary sector includes businesses meeting consumer wants, whose revenue depends on consumers' disposable income. The sector includes industries like automotives, luxury and sporting goods, hotels, restaurants and travel, e-commerce and retail, entertainment, and cosmetics and beauty. Looking into these industries globally, we see that Tesla, Volkswagen, and BYD Auto are the biggest automakers. The largest luxury and sporting goods makers are Louis Vuitton, Moet Hennessy, Nike, and Adidas. Marriott International, Bookings Holdings, and McDonald's Corporation are the leading hotels, restaurants, and travel companies. The largest e-commerce and retail firms are Amazon, Walmart, and Rakuten. Comcast Corporation, the Walt Disney Company, and AT&T are the biggest entertainment firms. Lastly, the largest cosmetic and beauty firms are L'Oreal, Estée Lauder, and Govardhan. The financial sector covers companies that mainly handle money. The sector includes industries like banking, insurance, brokerage houses, consumer finance, mortgage-related real estate investment trusts or REITs, and financial technology or fintech. Looking into these industries globally, we see that JP Morgan Chase, Industrial and Commercial Bank of China, and Bank of America are the largest banks. The biggest insurance firms are China Life Insurance, Ping An Insurance, and AIA Group. The Charles Schwab Corporation, Bank of America's Merrill Lynch, and JP Morgan Chase are the leading brokerages. The biggest consumer finance providers are Visa, MasterCard, and American Express. Annaly Capital Management, Starwood Property Trust, and AGNC Investment Corp are the largest mortgage-related REITs. Lastly, the biggest fintech companies are Intuit, Fiserv, and PayPal. The real estate sector includes property developers and managers and real estate investment trusts or REITs. The sector includes industries like property management, shopping malls, public storage, healthcare facilities, communications real estate, digital infrastructure, and industrial real estate. Looking into these industries globally, we see that the largest property managers are CBRE Group, Jones Lang LaSalle, and Colliers International Group. Simon Property Group, Realty Income Corporation, and Regency Centers Corporation are the biggest shopping mall owners. The leading public storage providers are Public Storage, Extra Space, and CubeSmart. Welltower Inc., Ventus, and Health Peak Properties are the largest healthcare facility owners. The biggest communications REITs are American Tower, Crown Castle, and SBA Communications. Equinix, Digital Realty Trust, and Iron Mountain are the leading digital infrastructure REITs. Lastly, the largest industrial REITs are Proluxis, Rexford Industrial Realty, and East Group Properties. The communication services sector covers businesses that transmit data as text, voice, audio, or video across the globe. The sector includes industries like wireless communications, telecom equipment manufacturing, and telecom services. Moreover, telecom services covers fields like internet services and traditional TV, social media, internet search and digital advertising, video games, streaming, and traditional advertising. Looking into these industries globally, we see that China Mobile, T-Mobile, and Verizon Communications Inc. are the largest wireless communications firms. The biggest telecom equipment manufacturers are Cisco Systems, Foxconn Industrial, and Motorola Solutions. In the telecom services industry, Comcast is the largest internet services and traditional TV company. The biggest social media business is Meta Platforms Inc., formerly known as Facebook. Alphabet or Google is the leading internet search and digital advertising firm. The largest video game creator is Microsoft's Activision Blizzard Inc. Netflix is the biggest streaming company. Lastly, the largest traditional advertising business is Publicis Group. The energy sector includes businesses that operate in the oil and natural gas space. The sector includes industries like oil and gas exploration and production, consumable fuels production, and oil and gas industry equipment, materials, and services provision. The sector doesn't include renewable energy companies, as those are considered utilities. Looking into these industries globally, we see that the biggest oil and gas exploration and production firms are Saudi Aramco, ExxonMobil, and Chevron Corporation. China Shenhua Energy, Coal India, and Glencore are the largest consumable fuels producers. Lastly, the leading oil and gas industry equipment, materials, and services providers are Schlumberger, Halliburton, and Baker Hughes. The industrial sector covers a variety of businesses that utilize heavy equipment. The sector includes industries like transportation, aerospace, defense, construction, engineering, and equipment and machinery manufacturing. Looking into these industries globally, we see that the largest transportation companies are Delta Airlines, Union Pacific Corporation, and Hapag-Lloyd. Honeywell, Boeing, and Airbus are the biggest aerospace firms. The leading defense companies are Lockheed Martin, Raytheon Technologies, and Northrop Grumman. Vinci SA, Larsen & Toubro, and D.R. Horton are the largest construction businesses. The biggest engineering firms are Siemens, ABB, and Hitachi. Lastly, Caterpillar, John Deere & Company, and United Heavy Machinery are the largest equipment and machinery manufacturers. The information technology sector includes companies involved in different aspects of technological innovation. It is the largest among the 11 GICS equity sectors and includes industries like internet software and services, IT consulting and services, cybersecurity, artificial intelligence, data processing and services, and application software. Looking into these industries globally, we see that the largest internet software and services companies are Alphabet, Amazon, and Meta Platforms. Accenture, Tata Consultancy Services, and Automatic Data Processing are the biggest IT consulting and services firms. The leading cybersecurity businesses are Palo Alto Networks, Fortinet Inc., and CrowdStrike Holdings. Microsoft, Alphabet, and Tesla are the largest artificial intelligence companies. The biggest data processing and services firms are Amazon, Alphabet, and Microsoft. Lastly, Salesforce, SAP, and Intuit Inc. are the leading application software businesses. The information technology sector also includes industries like database management, home entertainment software, consumer electronics, computer hardware, and scientific and technical instruments. Looking into these industries globally, we see that the leading database management firms are Oracle, Microsoft, and IBM. Netflix, Disney, and Microsoft's Activision Blizzard are the largest home entertainment software companies. The biggest consumer electronics businesses are Apple, Samsung, and Sony. Dell Technologies, HP, and Western Digital Corporation are the leading computer hardware firms. Lastly, the largest scientific and technical instrument firms are Keyence Corporation, Fortive Corporation, and Hexagon. The massive IT sector also includes industries like electronic component manufacture, semiconductor manufacture, electronics and computer distribution, semiconductor equipment and materials production, and solar energy technology. Looking into these industries globally, we see that the largest electronic component manufacturers are Amphenol Corporation, Foxconn Industrial, and TE Connectivity Limited. Nvidia, TSMC, and Broadcom are the biggest semiconductor manufacturers. The leading electronics and computer distributors are CDW Corporation, TD SYNNEX Corporation, and Arrow Electronics Inc. ASML Holding, Applied Materials, and Lam Research Corporation are the largest semiconductor equipment and materials producers. Lastly, the biggest solar energy technology firms are First Solar, Enphase Energy, and Jinko Solar. Equities can also be grouped by market capitalization or market cap, which is what the market thinks the underlying business is worth. This results in 5 equity groups: micro, small, mid, large, and mega cap stocks. Microcaps are businesses valued under $250 million, for example, Semler Scientific and VitalHub Core. They are the most volatile, riskiest, and illiquid market cap category. Illiquid meaning it's not easy selling their shares, usually due to low trading volumes. Moreover, the scarce data on them makes research difficult, which leaves investors vulnerable to fraud and other risks. Small caps are businesses valued between $250 million and $2 billion. Good examples are Agilicis Inc. and Docebo Inc. They have historically outperformed larger cap stocks, but they are also more volatile, riskier, and less liquid. Moreover, some of them are plagued by the same issues as microcaps, that is, lack of information and illiquidity. Mid-caps are businesses valued between $2 billion and $10 billion. Good examples are Elf Beauty Inc. and Descartes Systems Group. As their name implies, they are in the middle of their growth story and are projected to keep growing earnings and market share. Moreover, they provide diversification in the portfolio by contributing a balance of growth and stability. Large caps are businesses valued between $10 and $200 billion. Great examples are Paycom Software Inc. and Manulife Financial Corporation. They dominate the major benchmark indices across the globe, for example the S&P 500. These firms are usually transparent, making sufficient data publicly available to ease investors' research. Moreover, they are typically blue-chip companies at the peak of their business cycle phases, producing established and stable revenue and earnings with lower volatility and often pay dividends. As a result, they normally form the core of most investors' long-term strategy. Megacaps are businesses valued over $200 billion. A great example is Microsoft Corporation. Another one is Alphabet Inc. These Goliaths sell tons of goods and services in any reporting period and as such have an outsized influence in the industries in which they operate. But that's a double-edged sword because if these firms experience a persistent slump, the broader market could be heavily affected. So while megacaps share a lot of benefits with large caps, for example transparency, data availability, stable returns, and lower volatility, they do come with a fair amount of concentration risk. Equities can also be grouped by market classification or location, that is, where the businesses mainly operate in. Doing so results in developed and emerging market equity groups on one hand, and on the other, local and foreign equity groups. Developed markets have higher household incomes, adequate infrastructure, and mature capital markets, meaning their markets have greater stability, transparency, and liquidity. They have well-regulated exchanges, established trading platforms, and investor protection mechanisms. Developed markets are mostly located in North America, Western Europe, and Australasia. Emerging markets have rapid economic growth and development, which are driven by younger populations, higher consumption levels, and a strong modernization drive. But they also have lower household incomes, inadequate infrastructure, immature capital markets, and bouts of political and economic instability. Emerging markets mainly include Brazil, Mexico, Saudi Arabia, Russia, India, Indonesia, China, and Taiwan. As a Canadian, when you buy Canadian stocks, you're buying local equities. But when you buy US stocks or stocks from outside Canada, you're buying foreign equities. The world doesn't entirely revolve around the US and the developed markets, and change is the only constant. In fact, current projections see emerging markets outgrowing their developed counterparts by the mid-2040s. Moreover, 2024 earnings growth forecasts show 19% earnings growth for emerging markets, beating the US's 10% and the developed markets' 8% earnings growth projections. Right, that does it for equities. Next, we'll delve into the fixed income or bond asset class.